Are you wondering what is going on with the interest rates right now and when we are going to see a break? If so, you are listening to the right podcast.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49 unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
His name is Nate Armstrong. He's the CEO and founder of HomeInvest. My name is Steve Warner. I am the Chief Investment Officer. And today we are going to be talking about mortgage rates, what the forecast is, what this means to you, and how you can actually find an amazing investment right now for your passive investments because of what's going on with interest rates. Let's go ahead and jump into it. Nate, talk to me a little bit. What's the forecast right now for mortgages in the next 6 months? We're here right now in August of 2023.
Yeah, well, the Fed just raised rates again, and we're expected to see them raise all the way through the end of this year and a little bit into next year. And this is crystal ball talk, mind you, but the forecasts and the betting markets are all saying that sometime next year will start to come down. But for the foreseeable future, at least the next 6 months, we're going to see increasing up and up and up. We could even see 8% for home loans by the end of this year, which means that investment property loans will probably be 1% to 2% higher.
Well, I mean, this affects us a couple ways. And if you're listening to this and you're like, no, they're going to lower it. They have said repeatedly that they will keep raising interest rates until inflation is back down. I've heard like sub 2% right now. So just so you know, last year, at the end of last year, according to, this is on Forbes, at the end of last year, right now we are at 4.1, and they've said they're going to keep raising interest rates until we are sub 2s. So what does all of that mean? Let's break that down. What happens, Nate, when inflation goes up, when the economy tightens a little bit? What happens to solid rental properties?
Yeah, typically rents start to increase. That's usually what happens. You have a couple of dynamics happening. You've got, number one, people can no longer afford to go buy a new house or a secondhand house. They can't afford to buy it because mortgage rates are too high. What they would have qualified for 2 years ago with a low interest rate, they no longer qualify for today. Same thing applies to people that need to refinance. If they had a loan that was expiring for any reason right now, and it was a lower interest rate, and now they have to refi into today's market, they might no longer qualify for it. And so a lot of times those people that would have been a homeowner, they're turning into a renter. And so we put more pressure on the rental market. And I know right now people are saying things like, well, the inventory, it's still short. Let me tell you, like, the inventory is not that far off. Nationwide, we're about 1 million homes short per what the experts say. 1 million homes is not that many. I mean, just simple Airbnb properties right now, there's probably about 2 million sitting vacant since Airbnb started coming down and the short-term rental market came down. And if half of those people decide to sell, or 1 million out of the 20 million long-term landlord rentals decides to start selling their property in the midst of the recession, it changes the inventory game really, really fast. So it's a long answer to your question, Steve, but typically rents will go up during an environment like this.
And these are solid C rentals. What that means is these are working class, like they're nothing fancy, and they're not the luxury rentals. They're also not junky. These are like nice, solid, boring rentals where everybody can afford to live. Those tend to, one, fill up, and then because there's less inventory, the prices tend to go up. So if you're looking for a good investment right now, you want to look in that solid C-class property. The other thing that you want to look for, we're talking about interest rates right here. We're seeing a lot of properties come onto the market because they're hitting a balloon period where their interest rate is going through the roof, which means they have to sell. How does that affect us, Nate, as the person going out and finding these properties? What are we looking for, and how are we actually like digging through all of them to find the needle in the haystack that works best for us?
Yeah, so we just walked a $12 million building last week. And in that property, the current owner, they've owned it for going on 3 years. They took out a 3-year loan when they bought it. It was a renovation loan. They had the intent to go in there and renovate most of the units, bump the rents up, and then turn around and sell it to someone like us. And what they found is that during COVID, they hit some roadblocks. They couldn't get rid of some tenants and they had to juggle things around. Anyways, what's happening is that now towards the end of their loan, they're forced to refinance. They have to. The current lender won't keep them, and so they're forced to sell. It's kind of like the plane was on the tarmac. The pilot got it cleaned. The pilot got it loaded. He was about to press the takeoff button, and then all of a sudden, traffic control is saying, "Nope, sorry, pilot, you're out. You got to switch." And so he did all of this work to the property, got it ready, but he hasn't realized that property in flight yet. So he's not able to sell it for what he thought that he could sell it for because the rents haven't been bumped up to where he thought they would be at this time. So we're able to step in, grab the keys for the plane, and then now we're going to finish the job. But we get to benefit from all the work that he's done over the last 3 years.
Okay, so I'm going to play devil's advocate a little bit. What makes us qualified to come in and, one, take over that property, and two, why are we going to get any better results than he did?
Yeah, number one, we don't take risky short-term debt. It's kind of like taking a grenade and pulling the pin. Like 2-year loan, 3-year loan, like you know it's going to expire. You know that a grenade's going to explode when you pull the pin. It's just a matter of time. We don't take grenade type debt. We're gonna lock in on day number one. So going into this deal, even though the rest of the market is paying 7%, 8%, even 9% for loans, because we have a really good relationship with Freddie Mac, agency debt, we're good long-term borrowers, we're customers of theirs right now. We were just quoted from our mortgage broker, Greystone, which is a huge lender in this space, that we can come in for 5.5% long-term fixed. So that's step number one. Like we're not going to take grenade type debt. Okay. Step number two, we're looking at current rent rolls. We look at what's called the T3s and the T12s. T stands for trailing. So we're looking at the trailing 3 months of income and expenses. And we're also looking at the trailing 12. And what we've noticed from the last seller is that they did tons of renovation work. Like all the way up until 9 months ago, they were still renovating, and they haven't realized leasing out those units at fair market rate. They haven't realized all of the potential that they have. For example, when they did the pro forma for the property, they thought they would rent out these units for $895. One of them just rented last week for $1,100. They thought they were going to get $895. It rented for $1,100. But they've already committed to selling and they haven't leased all the units yet. We're going to be able to step in and lease the remaining of them. And they're at 90% occupancy today. So it's not like there's a bunch of vacancy. It's just that they're at the end of their loan. The clock ran out. The grenade is about to blow up on them.
Okay, so if people are looking for a great passive investment, the thing that they're looking for then, from what we're talking about right here, you want to make sure that you have a low interest rate. Whoever you are joining, whoever you're investing with, whether it's us or whether it's somebody else, you want to make sure that they have a locked interest rate and you want to make sure it is low. You don't want anything, I would say 5.5%, 6% would be the max. And you definitely don't want somebody who is doing a 3-year adjustable or even a 5-year adjustable. You want long-term